All right, show of hands, who wants to pay more taxes this year? I didn't think so. In this video, I'll be revealing the perfect plan to have a $0 tax bill this year by following a step-by-step framework that leverages multiple tax reduction strategies, all working together. Through working with retirees who have implemented these tax optimization strategies and saving them hundreds of thousands of dollars in lifetime taxes in the process, I've identified how to coordinate multiple approaches to dramatically reduce your tax burden and extend your retirement savings. And be sure to stay till the very end because I'm going to show you a surprising truth why in some cases paying $0 in taxes might actually hurt your long-term plan. I'll show you when and where it's smarter to pay a little bit more taxes now in order to save a lot more in taxes later. So if you're new to the channel, my name is Ben. I've been a financial advisor for almost 20 years, and I want to help you have an even better retirement. All right, step number 1, live off your Roth accounts tax-free. Now, if your goal is to have a 0% income tax year, the simplest place to start really is the money you've already saved for this express purpose, your Roth IRA and your Roth 401k. If you've been contributing to these accounts for years, letting those dollars grow tax-free, now is the time in retirement we get to finally enjoy those accounts. So qualified withdrawals from a Roth account actually don't even appear anywhere on your tax return. They don't count as income. They don't affect your taxation for Social Security. There's no IRMA worries. In fact, this idea is so simple, I wanted to illustrate it on our tax software, but I really can't because there's no inputs. All right, now with that being said, all right, big danger warning signs, right? Danger, Will Robinson. If you're headed down this path for the reason I think you're headed down this path, you've got to be very careful. A lot of times people aim for a $0 tax year because they're trying to lower their income for the Affordable Care Act premiums because we're trying to solve for health insurance before 65. The lower your income is, the more assistance you can get to help pay for your health insurance, right? Lower income equals lower premiums. But here's the catch. If you live entirely off of your Roth IRA or Roth 401k, that income doesn't show up on your tax return, right? So your modified adjusted gross income would be $0, right? That makes sense. But when that happens, the ACA marketplace, the Affordable Care Act marketplace, can actually move you into Medicaid, which is a completely different healthcare program than you're probably interested in, right? So you and or your financial advisor really need to research this because it's very state specific and you may or may not actually want that outcome of being forced into Medicaid. We're also going to look later in this video at a different kind of $0 tax year, one that uses not Roth dollars, but long-term capital gains. And that actually has a polar opposite effect on the ACA income calculation. So if you're trying to solve for the Affordable Care Act premiums, make sure you stay until the end. I'll jump into my tax software here on my computer, and I'll show you exactly why these two zero tax strategies behave so differently when we are solving for our health insurance premiums. Also, if you're planning on achieving a $0 tax year using a Roth, there are really two rules I should bring to your attention. Number 1 is accessing your basis. Now, you can withdraw your Roth contributions anytime you'd like, both tax and penalty free. That could be pretty important to you if you want to retire before age 59 and a half. We also want to think about that 5-year rule. So to withdraw your earnings tax-free, you've got to have your first Roth must be at least 5 years old, right? The clock starts on January 1st of the first year that you either contributed or converted. So for most retirees who've been saving consistently, both rules tend to be satisfied kind of automatically depending on when you want to retire, which of course then means you can start living off of your Roth accounts completely tax-free if that is your number one goal. So Roth income gives you a foundation of true tax-free spending, but step number 2 expands that idea into another way to access cash without triggering any income at all. And it's probably the strategy that your favorite billionaire uses to reduce their tax bill. And that's step number 2, which is buy, borrow, die. You probably heard this phrase tossed around a lot when people talk about billionaires and taxes. That's actually available in a scaled down version for us non-billionaire normies that anybody can use. So when you borrow against an asset, those loan proceeds aren't income, which I suppose is a good thing, right? Think about the last time you borrowed money for the purchase of a house or a car. Luckily, you didn't receive a 1099 form at the end of the year requiring you to pay taxes on those funds because, loan funds aren't taxable. So now using that same idea, you can just borrow against your non-retirement investment portfolio. Now again, giant red flashing lights, right? Danger, Will Robinson. As simple as this strategy is, it's not without its risks because the stocks in your portfolio really now, once we're loaning against them, they are serving as collateral for this loan. You're borrowing what's called margin. So guess what happens, of course, if your stocks go down suddenly, which stocks are sometimes, of course, known to do, well, you get a margin call, meaning that if you don't deposit funds into your account, your stocks that are collateral now for this loan, they're going to be sold to pay your debt. And they're probably going to be sold at a time you don't want to be selling stocks when they're, of course, down. So valid strategy, just use it carefully. And just like anything else in life, debt is leverage. And leverage can make good things really good, but it can make bad things much, much worse. So far we've seen how to live tax-free with our Roth and borrow tax-free. Let's look at a third way how to realize income that's taxed at 0%, and how this strategy might maximize your 0% tax bracket, but it could also potentially blow up your health insurance if we're not careful. And that's step number 3, the 0% capital gains opportunity. Now, would you believe that you can achieve a 6-figure income without paying any taxes at all? It's true, and it's built right into the tax code. So let's look at the numbers. For 2025, the 0% long-term capital gains rates applies to about $48,000 of income, taxable income for single filers, and roughly $97,000 for married couples filing jointly. And remember, that's taxable income, not total income. Before you get there, you get to subtract your standard deduction, about $15,750 for singles and $31,500 for married couples. And even better, if you're 65 or older, we've got a larger standard deduction over 65 and now a new senior bonus deduction, which is going to be $6,000 for singles and $12,000 for couples. Now, this is going to sound wild, but that means for a retired couple, both over 65, you could have roughly $140,000 in total income and still owe no federal income tax on your long-term capital gains. If that's your only income, you pay $0 in taxes. I know these numbers might sound unbelievable, and I don't want you to take my word for it. Let's dive into our tax software. We'll look at some of these numbers for ourselves, and you can see it with your own eyes. Now, remember, it's important to note that we're also going to talk about how this figures into your health insurance premiums if you're using the Affordable Care Act and you're not yet 65. So we're going to look at a few examples. We're going to look at 4 examples in our tax software. I think everybody remembers our normal test subjects. This is Jim and Pam Halpert from Scranton, Pennsylvania. They work at a paper company. So this is our scenario analysis. I know this is kind of a lot to look at, but we've got 4 scenarios here. We've got 2025 tax year, single under 65, 2025 married filing jointly under 65, 2025 single over 65, and we have 2025 married filing jointly over 65 plus a Roth conversion. Oh, here's scenario number 4 as well. We'll talk about scenario 5 at the end, but scenario number 4 is 2025 married filing jointly over 65. You're probably wondering what these little orange warning signs are. I'm changing their birthday over 65, under 65. So, of course, tax software does not like that when your birthday changes, more than once in a tax year. So that's what that error is for. But first thing, let's start out with 2025 single under 65. And what we're looking at here is for Pam Halpert on her own. And we're looking at how much long-term capital gains could we have? $64,100. And I moved this up and down 100 here and there just to see how close we could get. So that's for only income this year, $64,100. And this would be a case where if someone is retired and they're not yet collecting Social Security or any earned income or any pension or anything like that, they're just living off of their non-retirement investments. So what then we do is we look at our tax report because that's going to pull our most important numbers to the surface here. And 2025 tax report for Pam Halpert, we've got $64,100 of income, $15,750 of deductions. Now this is under 65. We're going to watch for over 65 because that number will change. Subtract that out. We've got $48,350, and look at that. We've got total tax of $0. Right? We do have marginal bracket of 10%, but our average rate is $0. And safe harbor doesn't really apply here, but that's also $0. All of our income is derived from our long-term capital gains. Now, what we want to think about, we are under 65. And all of our income is coming from capital gains. So if we scroll all the way down here, we want to look for Medicare. So MAGI, Modified Adjusted Gross Income definition number 6, is our ACA premium credit, right? So our income is $64,100, which is 426% of the federal poverty limit. Now, generally speaking, 100 to 400% of the federal poverty limit is where you're going to get your ACA subsidies. So in this instance, Pam is likely over where she's going to get some subsidies. Now, contrast that with living off of your Roth IRA for the entire year. Your Roth IRA for the entire year, well, your income here would be $0. So you would think, well, that's going to help me get the most ACA tax credits for the smallest amount of premium possible. And that might be right, but state specific, check with your advisor. It might also push you onto Medicaid. And you may or may not want that. So we're going to have to talk about how to navigate that. So that's our single Pam as a single person. She's taking $64,100 out of her investments and paying absolutely no tax on them. Pretty neat rule. What happens if we are married filing jointly under 65? That's scenario number 2. We've got Jim and Pam Halpert, both under 65. Their only income for the year is capital gains, long-term capital gains, $128,200, as you can see there. They've got no earned income. They've got no other income. They've got no Social Security, nothing like that. So let's look at their tax report. And here we've got Jim and Pam Halpert. Total income, $128,200. We've got our married filing jointly deduction for under 65, which gets their taxable income to $96,700. Absolutely no tax at all, right? Pretty good deal. If we scroll all the way down to our Medicare premiums, one neat thing to think about, since they are under 65, so this doesn't really apply, but if we're playing by the rules of 0% tax year, we're automatically going to be on the friendly side of any IRMA situations. Those don't kick in until we'd be paying some pretty significant capital gains on our income. So that's one of those rare areas where if we're solving for one, we're kind of automatically solving for the other, which is nice. We keep scrolling all the way to the bottom. We want to look for our modified adjusted gross income definition 6 for our Affordable Care Act premium credit. Now, we've been able to earn a large amount of income. We're talking $10,000 a month of income, completely tax-free, but we're 620% above the federal poverty limit. So it's extremely unlikely they're going to get any premium assistance using this kind of a strategy. And we'll talk about how to potentially solve that here in a moment. So I mentioned earlier where we're looking at what's the sweet spot between living off of my Roth IRA for zero tax or using the capital gains rules for zero tax. If I'm solving for ACA premiums, we have to approach that slightly differently. I will cover that after we're done looking at these examples. Now we've got scenario number 3, 2025 single over 65. Pam Halpert, everything is exactly the same except now she's 65. So we can go from $64,100 now to $72,000. Again, that's her only income. And that there's 2 reasons why we can do that. The first is because we have a larger standard deduction. So if we look, I think we can scroll down here. We have a $15,750 standard deduction when we're single or when we're under 65, and single over 65, $15,750. So we have a little bit extra there. And we also have our enhanced senior deduction of $6,000. So everything else being the same, we can take out more. Capital gains, $72,000, bigger standard deduction, taxable income here, enhanced senior deduction here. Absolutely no tax there. And because she's over 65, we want to double check that we are good on her Medicare premiums, and we are. So for 2025, this is going to be for 2027 Medicare premiums. We've got $106,000 is where our first threshold kicks in. And of course, she's comfortably underneath that at $72,000. And then finally, we want to look at married filing jointly over 65. Let's check on Jim and Pam. Same scenario. We've got now a bigger standard deduction, $31,500 here. Now we're at $34,700 here. And we've also got our senior bonus deduction here, which is $6,000 each, totaling $12,000. So let's see what our total income can be. And this is 2025 married filing jointly over 65, Jim and Pam Halpert, $143,000. Bigger standard deduction because we're over 65. Senior bonus deduction because we're both over 65, $12,000. Taxable income, $96,300, and total tax, $0. Kind of unbelievable that you can have well into the 6 figures of income. We're talking well over $10,000 a month in income and pay no income taxes whatsoever. Now, that may or may not be a really good deal depending on what you're solving for. And since they're over 65, really over 63 is when you want to double check that because that's when they're keeping track of your income for Medicare. But we're under $212,000 with our $143,000 of modified adjusted gross income. So we are safe in that realm there. When you're thinking about your IRMA number, it's generally going to be the biggest number, the largest income number. I know modified adjusted gross income is kind of hard to remember. Generally going to be the biggest number on your return. There's a lot to look at with our tax software. So just to sum it up quickly, single under 65, we're looking at about $64,000 of capital gains and zero tax. Married under 65, we can double it, $128,000 of income, capital gains income, long-term capital gains income, no tax. Single over 65, $72,000 in capital gains, no tax. And married over 65, $143,000 of income, no tax. Okay, let's dig a little bit deeper into what this means for our health insurance planning. So we've got a married couple in this example, 65 years old, under 65 years old, $128,200 of total income, all of it long-term capital gains. Now, as we demonstrated, their total federal tax bill is $0, which is great, but their modified adjusted gross income is $128,200. On the Affordable Care Act scale, they are going to look at that number. That's about 627% of the federal poverty level. Now, to qualify for premium assistance under the ACA, most households are going to need to be between 100% and 400% of the federal poverty level. So even though this couple does not pay any tax, they're really quite a bit above the subsidy range, meaning they did receive little or no assistance from the ACA. Now, if they did the opposite and they lived entirely off Roth withdrawals, well, their modified adjusted gross income would then drop to $0. potentially qualifying them for Medicaid. Now, neither extreme may be ideal for your unique situation. Really, I think the sweet spot, if you're balancing taxes and ACA subsidies, we want to combine those two strategies, right? We want to harvest enough long-term capital gains, let's say to reach 300% of the federal poverty level, and then cover the rest of your spending from your Roth accounts. That mix might give you about $10,000 per month in total retirement income, $0 federal tax, and meaningful ACA credits. But remember, this is just 1 year, right? Our biggest advantage over the IRS is our flexibility and our time, right? The IRS only looks at one tax year individually at a time, January to December. But we, as super savers and as retirement planners, we can plan across 20 or 30 years and decide what's the best rate to pay taxes. So a single year, zero tax plan, well, that's really going to lower your lifetime taxes. And that's really going to be a much bigger bill in retirement than, whatever one single year of income tax is going to be or one single year of like ACA credits would be. So the real one is combining these tools to decide how much you're going to pay, not just this year, but over your entire retirement. So that's the real nuance of ACA credits that I mentioned earlier. Roth withdrawals might show zero income and might push you towards Medicaid, while capital gains income still counts for ACA subsidies. So understanding the difference is really key if you're going to retire before age 65. And that brings us to step number 4. When paying some tax is actually smart. So a $0 tax year sounds pretty fantastic, but it's not always the best long-term move. Eventually, Social Security, required minimum distributions, or maybe an inherited IRA or something similar can push you into higher tax brackets later. Sometimes it's better to intentionally recognize a bit of income today while your effective tax rate is low. Historically, households earning six-figure incomes have paid much, much more in taxes than they do pay today. So I found some sources from the Congressional Budget Office, and they looked at income from 1979 to 2018, and they wanted to look at effective tax rates. So effective federal tax rates for upper middle income households, kind of that low six-figure range, averaged between 18 and 22% between 1980 and 2000. Compared to, let's say, 8 or 10% effective tax rate today for similar incomes, we're getting kind of a fantastic deal today. Now, of course, the examples we're looking at today are a specifically engineered 0% rate, but we're talking about normal years where you might not specifically be solving for a $0 federal income tax. So combine that now with a supersized standard deduction. We've got our senior bonus deductions, right? The best thing to lower your lifetime tax bill could be to pull forward cash flows from the future into the present and lock them in at these historically hyper low tax rates. So the most common examples of reaching forward and pulling forward cash flows is Roth IRA conversions and or capital gains harvesting beyond the 0% capital gains bracket. So let's take a look at what that might look like. And that brings us to our last scenario, 2025 married filing jointly over 65 with a Roth conversion. So we're kind of combining all of the different scenarios together and solving for long-term capital gains plus Roth conversions. Now they're over 65, so they're really not solving for the ACA credits anymore, but they might be keeping their eye on IRMA. They don't want to pay more for their post-65 Medicare health insurance. So we've got our same capital gains here, $143,000 of long-term capital gains. We still have our same total income, same adjusted gross income, same increased standard deduction because they're over 65. And we are going to get some senior bonus deduction. I think you'll be interested to see how that changes. We also have, I think I scrolled right by it. Yes, we're also looking at a $68,000 Roth conversion to be equally distributed between both accounts. So I want to show you what that looks like. What if we voluntarily pay a little bit more taxes now? I'm not going to show you a calculation of what the total tax savings might be. That's probably a different video for a different day. But now look at their income. They've got $211,000 worth of income, and they were able to move $68,000 from their traditional IRA to their Roth IRA. We've got the same larger standard deduction because they're over 65. We lost a good amount of our senior bonus deduction. It was $12,000, now it's $4,680. We still get to use a bunch of that, but we've been phased out because our income is higher. We have income in the 12% bracket, but if we take our total tax, $14,195, into our total income, we have an average rate of 6.7%. So we're paying paying 6.7 cents on the dollar for federal income tax. Now, the question to ask ourselves is, yes, a $0 tax year is wonderful, but 6 or 7 cents on the dollar, don't show this video to your middle schoolers, by the way. You'll know exactly what they're going to say if they see those two numbers together. But if we're dealing with 6.7 cents on the dollar, historically, is that a good deal? I think it's a fantastic deal. Like we looked at with our other research from the congressional, what was it, the CBO? Right, the CBO thought a similar income would have between an 18 and a 22% effective tax rate. Here we've got a 6.7% effective tax rate. Historically, that might be a smoking hot deal. Ultimately, only you can decide what feels like a good deal or not. Now, we would want to double check, of course, since these guys are over 63. Are they going to have any impact to their Medicare premiums? And of course, since I solved this ahead of time, I know that they don't. We're staying comfortably under that $212,000 for IRMA. This would be a 2025 number for 2027. And so we're paying our normal $185 each Part B premium. Again, if we were to creep over, if we thought this was a really good deal and we wanted to pack more income into that kind of low double digits or high single digits effective tax rate, we could even creep into here. We're paying then about an extra $75 a month times $250 a month. In the grand scheme of your lifetime tax bill, probably not going to move the needle too much if you do want to reach forward or reach into the future and draw forward some of those cash flows. So I don't want to get too long in the tooth here with today's video. I just wanted to show you a couple different options for $0 tax years and then give you sort of the devil's advocate argument of maybe that's a good deal for you, maybe not. Let's look at historical rates and figure that out together. So pull it all together. What do you get? Well, you get a flexible, realistic roadmap for a tax-free or a nearly tax-free full year of retirement. How do we do it? Well, we live off of our Roth accounts. We get true tax-free cash flow doing that. We can borrow selectively for tax-free liquidity. That's that buy, borrow, die strategy. We can harvest a lot of capital gains strategically and stay under that 0% tax threshold. And then potentially we can capture the correct amount of income from both capital gains and Roth accounts for our health insurance needs. And then when appropriate, we can pay a small extra amount of taxes in a smart way when rates make sense from a historical perspective. Ultimately, that's completely subjective to you, but I pointed out just because it's worth looking at. So again, this isn't magic. It's just math and it's just thinking outside the box. So by layering all these steps together in the right order, many retirees can achieve a strategic 0% tax year and keep their lifetime effective tax rate at really historic lows. So now that you understand the perfect plan to temporarily avoid taxes in retirement through coordinated implementation of some powerful strategies that all work together, you can dramatically reduce your lifetime tax burden rather than paying some unnecessary taxes. Now, if you want help implementing these strategies and creating your personalized plan for minimizing taxes, go ahead and click the link in the description, book some time with me, and I'll show you how to optimize everything we talked about today. So that's what we got for today's video. I hope you enjoyed it. Until next time, my name's Ben, and I hope this video made your retirement even better. We'll see you on the next one.